Good afternoon, ladies and gentlemen. Thank you so much for joining us. As the current nervousness in the global markets has revealed, we are continuing to see the credit markets tighten and unravel. And this afternoon we are talking about the role of rating agencies, among other agencies, how we got here, and when we might see a let-up in the current nervous conditions. Joining us here on stage, all the way to the left, Guillermo Ortiz, Governor of the Central Bank of Mexico; Raymond McDaniel, Jr., Chairman and CEO of Moody's Corporation; Malcolm Knight is General Manager and Chief Executive Officer, Bank for International Settlements, Basel; and Walter Kielholz is Chairman of the Board of Directors, Credit Suisse in Switzerland. Nice to have you all with us, gentlemen. Good afternoon. Let's first talk about how we arrived at this nervous moment in the markets, and whether or not any of you see any signs that we actually could find a nearing to the end of this volatility. Malcolm, can you kick us off?
Well, I think, first of all, Maria, the way we got here is pretty clear. We've had several years of very low interest rates, reach for yield by investors, a lot of borrowing to buy assets, a lot of leverage, asset prices, price of risky assets going up very rapidly. That is a reflection of the fact that big financial imbalances can grow up even when inflation is low and growth is strong. What goes up must come down, and so the trigger mechanism, I guess, was the avalanche of ratings downgrades last summer. But whatever the mechanism had been, there would have been at some point a withdrawal from this risk preference. That's what we're seeing now. The system is deleveraging. Deleveraging is always a painful process, has some special features this time because of the SIVs and ABCP conduits having to be brought back onto the bank's balance sheets. But basically, deleveraging means asset price deflation, and that's what we're in.
Walter, are there any signs in your mind that we might be nearing an end to this, or is it still open-ended?
As you know, one should never make forecasts, and certainly not about the future. But I think, personally, the first step has been the reassessment of the risk premiums. That has taken place. It usually takes place in shock waves and not gradually. It takes place in steps, and I think we are now in the situation where we try to find a new equilibrium. Probably the most unknown factor is what the real damage to the underlying product is. And as long as we do not know what the default ratios in subprime mortgages, what the default ratios in other instruments really is stabilizing to, I think there is a lot of uncertainty about the final outcome. I might also say that maybe some of the risk is now that we will have a strong flip back or something, also not gradually, but maybe fairly strongly. So I also see a certain risk that those which have not been damaged when the wave was coming in might get damaged when the wave is going out. So to make predictions about when this is going to happen, I'm not in a position to do that.
Guillermo, how do you see it? How did we get here?
Well, the first thing I would say is that I'm glad that this time we didn't cause it. I've been through more financial crises than I care to remember, and they all share a lot of common features. This one in particular, of course, has, is the more complex and sophisticated products and so on. But one thing that is common to all crises is the kind of lack of transparency. During the crisis of Mexican crisis of '95, there were complaints that there was no disclosure of the so-called tesobonos in circulation at the time. And in fact, there was a publication every week, but only nobody cared to look at it. And it was not very well publicized. During the Asian crisis, also there were huge complaints about the lack of transparency and crony capitalism and everything around this. And the same is being heard today. Perhaps the transparency issue this time is that, as Malcolm was saying, the complexity of the products and financial innovation made it more difficult. It was even difficult for regulators to understand these things, and also for not only for the issuers and for the buyers. So it was, I think, a little bit an exercise in collective confusion. But I think that one of the major aspects of it is that confidence has been lost in the core of the system, and confidence must be restored. So the issues here are capital, liquidity, and disclosure. That's what I would think.
Raymond,
short term.
I'm sorry?
Short term.
Raymond, a lot of talk about the ratings agencies and other agencies as well, and regulators as well, possibly dropping the ball here. In retrospect, what could have been done better?
Well, there are a number of things, and some of them are, I think, the responsibility of the rating agencies. Some of them are responsibility of other participants in the marketplace. As far as the rating agencies are concerned, I guess I would just introduce two ideas. One, I think in hindsight, it's pretty clear to us, and I think to others in the market, that there was a failure in some key assumptions that were supporting our analytics and our models. And those key assumptions failed in part because the information quality, both completeness and veracity of information that is feeding the analysis that rating agencies were doing, itself was deteriorating in a way that I think was far too much underappreciated by Moody's, probably by other rating agencies, and in hindsight, I think I would look for what kinds of early warning signals in terms of information quality or deterioration of information quality could have been looked to.
Marianne, can I pick up
Yeah.
your point on the question on how long this turmoil is going to go on, and also pick up on a point that Guillermo made. I think the issue here really is disclosure of asset values. Up to this point, if you take the 24 or so largest institutions, they've declared losses publicly on the order of just under 70 billion. The exposure to subprime alone is estimated to be somewhere between 250 and 600 billion.
Global.
Nobody knows where we are in this process. It's not a result of anybody wanting to hide things. The valuations are a moving target. The accounting rules are different, and it's very, very hard to price assets in these conditions. But as long as there's uncertainty about asset values, this deleveraging and deflation is going to go on. So the key thing to get past this and get assets to where investors think they're fairly valued is, as Guillermo says, more disclosure, more clarity about financial positions. And that, I hope, can help to prevent this financial turmoil from undermining the macroeconomy.
Because how do you, measure an asset when you don't, when you really don't know how to value it?
I had a question also regarding this to Raymond. You mentioned the difficulties the difficult to model these. With the available data, to model adequately the risk underlying structural products, if I understood correctly to some extent. Now, isn't it the case also that there was some confusion in the ratings? Because what I understand is that the probability or the idealized probability of default of a simple product, of a simple mortgage, which is rated AAA, is not the same as the idealized default probability of the AAA tranche of structured products, and you were calling them both AAA. So I mean, is this a source of confusion that is underlying this whole thing? Do you think?
Well, as far as expected loss associated with these instruments, the history demonstrates, interestingly enough, that, for example, investment-grade structured products have, over the two-decade period leading up to 2007, demonstrated lower expected loss or lower average loss than similarly rated corporate bonds. But what I think you're getting at, and I think it's an important point, is that loss distributions for structured products as opposed to the mean expected loss has been different. And rating transitions, whether favorable or unfavorable, have been more significant for structured products than they have been for similarly rated corporate bonds. So there is a different loss distribution, a different tail risk associated with those instruments, and that is an important point.
Ladies and gentlemen, get your questions ready. We'd like to go to the audience soon into this. You made an important point earlier, Ray, about the volume and the liquidity in certain rated bonds. Make that point again, because I'm not sure that people understand that just because you're lower rated doesn't necessarily mean you have low liquidity.
Yeah. The comment really was generated by a discussion about what is it that credit ratings are measuring and what is it that they are not measuring. And credit ratings measure expected loss or expected return of principal and interest over the life of an instrument. They are not measures of liquidity. They are not measures of the potential for mark-to-market changes or trading losses or gains, for that matter. And so in this respect, I think what we have seen is that they were being used for purposes beyond the boundaries of what they are well suited to be used for. And the comment being that certainly we can point to examples of single A or single double A rated instruments which have much greater liquidity than AAA rated instruments. And so to the extent that there is a liquidity sensitivity or that the instruments are held by margin sensitive mark-to-market investors, they may in fact be relying on highly rated instruments to do things which they are not particularly well suited to measure.
Who should be overseeing the ratings agencies? Should they be regulated?
Well, I can start with currently who's overseeing the rating agencies. We are currently regulated by the U.S. Securities and Exchange Commission. We are also subject to reviews on a voluntary basis, which the major rating agencies have all adhered to, by the Committee of European Securities Regulators and various national regulatory authorities around the world.
Can I just say, not on regulation of the rating agencies per se, but Ray's made the point that, well, ratings are really just about default probabilities. But the rating agencies are part of the infrastructure of the modern financial system in a way that makes what they do much more important than just rating the default probability. And I think that, again, in the area of disclosure and producing more information, what's really needed is for the rating agencies to show some of the other things that they do, which is to show more information about the rating of the loss when there is a default, the liquidity of the instrument, the rating stability, the extent to which the rating might migrate in bad conditions, and for structured products, much more information about the probability distribution of the expected returns, because these things are a lot more subject to tail risks than cash products. The rating agencies have that information. They can build it, and I think if they provide it, they'll give a lot more information to investors to make good business decisions without the need for a lot of extra regulation.
So you're talking about a lot more transparency. Exactly. Walter?
Well, I deal with rating agencies since 15 years, and a lot has changed. I said just before, when the first time I was a young member of the executive board and rating agencies would call, and that was 15 or 17 so years ago, and they had a question, we would tell them to read the annual report. And then I went through the whole process when this work became much more sophisticated. I was always a little bit amazed how fast, in my view, the young analysts were changing. We were always seeing other people. There was no consistency in how they dealt with us. And so there has been an observation in this direction from my part. The other one is, one has to see this is a duopoly in a way. It's two large rating agencies. They act very often in sync. They control this whole business. And they were, of course, extremely happy, to be a little bit provocative, when this financial innovation wave brought all these thousands and thousands of products which they could rate for a fee. And so I'm not so sure whether there all the time the discipline has been maintained, or could be maintained, because that was such a quick expansion of the business model. Second point, I think one element always gets forgotten, and in Latin it's called caveat emptor, and buyer beware. And somehow, when I listen to the discussion, there seems to be an entitlement that rating agencies are right, and that the highly paid institutional and private or institutional investor carries no responsibility for actually looking at the risk. And I sometimes have this feeling that this is somehow wrong. Caveat emptor.
If I may, I should go back and partly amend and partly reinforce a comment that actually Malcolm made with respect to transparency. And that is, clearly I have heard the comment from many sources in the wake of the credit crunch about greater ratings agency transparency. And the defense is that, in fact, we do publish, and they are publicly available, all of our methodologies, our models in structured finance. The assumptions can be tested, altered. People may disagree, agree, disregard the assumptions in those models. And so from a technical standpoint, the transparency is there and it is publicly available. However, many of the observations that we make, for example, publishing about ratings volatility or ratings transition risk, while those are observations we have made and publish on a regular basis, they are not embedded in the ratings themselves. And that is where I think you do make a good point. And one of the questions that we are being asked is whether we can include more of that information content in the actual scoring and rating process for these products, in addition to the traditional process of measuring expected loss.
What about Walter's comment that it's really a duopoly and the agencies work in sync?
Well, it's the industry has always been characterized by relatively few participants. Currently, there are 8 nationally recognized rating agencies, recently up from 7. We have been as low as 3 at various times in history. I would simply observe a couple of conditions that I think are relevant. First of all, there were relatively few players in this industry. There were only 3 that were active when ratings first began to be used in regulation. So I think there is a general assumption that regulation has created the current construct of this industry structure. that is certainly a point that is reasonable to debate. I simply observe that when ratings began to be used in regulation, the use of ratings took the existing market condition, which was 3 rating agencies, and used that market condition when developing rules and regulations. I would also point out that it is a standards business, and when one operates in a standards business, there is an important market need to have common standards across the industry, which I think has a tendency to concentrate the number of participants. Now, again, as we now have more rating agencies than we did 10 years ago, we will see whether that observation is valid.
Let's get some questions from the audience. Yes, right up front, first row. Thank you.
Yes, my name is Linda Walker, and I have a question for Mr. Kielholz. I would like to ask, we don't really know the final numbers, but I have the impression that Goldman Sachs, for example, and JP Morgan Chase have a lot less losses in the subprime area. And I was just wondering, how is it that certain players were able to stay out when other ones like Citibank have huge and massive losses?
Well, I don't know what exactly went on in the various institutions, but quite clearly there was assumptions and directional decisions made about investing in certain areas more or less. And that was based on market judgment, on risk judgment. That's the normal case. I don't think the normal situation is that somebody somewhere in the firm did something. I don't think that financial firms operate like that. I think the discussion about too much of a risk appetite in the market is a discussion which is already since 4 or 5 years there. If you had been right too early, you were also wrong, because financial institutions were under a lot of pressure to produce earnings. And if you said already 5 years ago, this is all crazy, the risk premiums are not right, the market operated fairly successfully for quite a long time. So various companies make different judgment calls as to credit risk, as to market risk, as to liquidity risk they want to take. And that is how a market actually comes together. Otherwise, if everybody would do exactly the same at the same time, there was no market. And so different institutions have taken different decisions. That's as simple as that, in my view.
Mm-hmm. It's a great question. Yes, sir. There a question on the right? Nope. Right here.
Chris Giles from the Financial Times. I was just wondering to what extent the panel believed that the increased use of ratings agencies' scores in regulatory activities, both in banking and even in central banking and collateral requirements, is actually part of the problem, and should regulations move away from using ratings themselves in future?
Malcolm?
Well, as I said, ratings are now built into the infrastructure of the financial system in many respects, in terms of what kinds of institutions have to post guarantees and collateral for certain types of transactions. And they're also built into the Basel Capital Accord, particularly the standardized approach of Basel II. Frankly, I think that if most of the international banks had been on Basel II at the time that the developments of the last 2 years took place, we would have had much less over-leveraging and much less of a bubble in asset prices, because the off-balance sheet vehicles would have had a proper capital charge against the liquidity facilities that were for them. But I think it is true to say that the whole question of the role of ratings in the regulatory system does have to be looked at. That said, I would remind you that really ratings influencing Pillar 1 of Basel II is just in the standardized approach. The more sophisticated banks have their own internal ratings-based approach, and if they can convince the regulators that those their own approaches are good ones, then those are the ratings that determine the risk weights.
Walter, did you want to add to that?
Well, I think the question is, with what other system do you replace the issues you have raised? That would lead just to another classification of assets, which are then actually allowed for collateral and others. And you would have probably a plethora of different standards per country somewhere, and per central bank, and for regulatory issues here and regulatory issues there. This is something which, for an internationally active financial institution, is impossible to operate in. So the big achievement is the standardization, as was said. The standardization where you can have classifications. Then the question is, what type of assets do you actually allocate to the various classifications? But at least you have classifications as an internationally operating financial institutions, which is a common nomenclatura in a way with which you can discuss. Otherwise, you end up in a Byzantine, fragmented, balkanized way of dealing with these issues.
Question in the middle.
Craig Drummond, this is probably a question for Raymond. Raymond, can you give us a sense, taking the focus off investment banks, can you give us a sense as to asset quality and your expectations about asset quality in the broader financial system?
Well, to the extent that we are looking at assets, my comments would really move to the originate to distribute model and the consequences of the originate to distribute model. What that does, I think what it does is it changes the condition we had once upon a time, which was that lenders and ultimate institutional investors were both investors in the same asset, albeit at different points in time, in that the lender was making an investment decision when it was making its loan, and it owned that asset. And as a result, it had a common orientation, albeit at a different point in time, than any ultimate investor in a pool of those assets. I think as the originate to distribute model became much more comprehensively used by more institutions, more countries, it caused an evolution so that there was not the sense of ownership on the lender's part. And as a result, there was a different attitude about viewing whether the loan being made, the asset being created, was in fact a good asset. And I think one of the gaps that opened in the market for credit was a failure for any party to step into that role of making the decision about whether the loan was in fact a good loan. So we have asset underwriters, we have securities underwriters, we have due diligence firms, we have rating agencies, and then we have the ultimate investor. And I think nobody stepped into that gap in terms of evaluating the quality of the original loan.
Maria, can I come in on that point? We haven't maybe talked about the originate to distribute model of the banks as much as we should as yet, and I think this is a very, very fundamental area. I think, you know, the originate to distribute model is basically, I think, has been a good model because it has very much diversified the revenue stream of the banks. It's made them much stronger, I think, financially than they were, say, in the late 1980s and early 1990s, and that really has contributed to financial stability. But as Ray said, in the process, with the origination, securitization, and selling off of instruments, even plain vanilla ones, not just the structured products, there has been a very marked deterioration in the standards of credit underwriting and loan origination. And in addition, the loans have gone to investors in many cases that have very little or no capacity to actually monitor changes in the credit quality of the credits they're holding. And they have therefore relied on the credit rating agencies and on asset diversification to protect them from that. And I think one of the things that the private sector will fix in innovating more and going forward with this model, which is fundamentally a good model, is to fix that deterioration somehow.
Can I come in for a second here? I think there is a problem of misaligned incentives in this whole model. The broker guy who sells the mortgage and who works for several services, he's interested in making the loan, and he collects a fee for that. And then the bank that makes the institution, which is not necessarily a regulated institution, then that's another big issue here, that there's a very thin line between regulated and non-regulated institutions. Same thing. Then what is interesting is making the loan and maybe packaging it into an asset-backed security and selling it to an investment bank that will create a CDO and so on and so on. And there's a fee process in every part of the chain. You are there in the business of collecting a fee and getting rid of the stuff. And finally, as it was mentioned here, there is a total disconnect between the original risk assessment that was behind the loan that was granted and the transformation of risk that the ultimate investor buys. So I think that the whole question of incentives is misaligned, and it's something that both the private and the public sector will have to look about.
Yes, sir.
Luc Bertrand from the Ackermans Group in Belgium. I am not sure I understand what you have said. I apologize to Mr. McDaniel. But basically, you have made the difference between solvability and liquidity, and mark-to-market. Now, we are seeing AAA ratings today, asset-backed securities at minus 20%. We are seeing single-A ratings at minus 40 to 50%. So, if I understand well what you said, and if the analysis was right, the solvability is good, and over time, those loans should be repaid and should be credit-worthy. Unless they are not, and then one has to wonder about a general case of fraud. And from my point of view, I am questioning this.
I think there are a couple of answers that are relevant to your question. First of all, some of the loss or write-downs are a recognition of some problems that were in the rating models, some problems with assumptions that rating agencies made, and that is a credit issue. In addition, though, a downgrade, while it causes a change potentially in the mark-to-market, or may cause a trading loss for someone moving that asset in the secondary market, does not mean that that credit is not money good. And so you may very well in the future see large amounts of write-ups of these assets as the market stabilizes and as there is more confidence in the price discovery process. And so it's a combination of several factors, some of them credit-related, and some of them not credit-related. And then the fact that there is an illiquid instrument, meaning that there is not a ready buyer, or that there is only a buyer at a deeply discounted value, again, may be an indication of a credit issue, but it may also be an indication of many other things. By analogy, I would say if rating agencies were rating houses, we would be rating the structural soundness of the house, its likelihood to still be standing 10 years from now. There are many, many other things that go into the value of a house. The neighborhood it's in, the attractiveness of the house, et cetera, but we are only measuring its structural soundness. To the extent that there are shortcomings in the credit analysis, the structural soundness, that is an issue for the rating agencies. To the extent that there are other issues affecting the value, that would not be related to what the credit ratings are measuring.
Yes, sir.
Edmond Fondery, CNP Insurance. A question for Mr. Knight. There is a lot of criticism of the supervision of the subprime mortgage loans in the U.S. over the last years. What is your position about that?
Well, I think this goes back to the issue that Guillermo raised about incompatibilities of incentives. I mean, there clearly was a lot of abuse and weak underwriting standards and abuse in the subprime mortgage market in the United States. But you have to remember that the way that market works, the mortgage originators are not financial institutions, and they're not primarily regulated by the financial authorities. And as many of you may know, there was actually one major mortgage originator that had a motto which was, our people don't get paid unless you get a mortgage. Well, that's not very incentive compatible with underwriting good credits. But I think here the problem really is the balkanization of regulation. Regulation is fragmented across market segments. It's fragmented across institutions. There are 53 insurance regulators, I'm told, in the United States, more than one banking regulator. It's regulated across national jurisdictions. And yet we want to have a global financial system. There has to be more conformity in the way regulation and supervision are implemented across jurisdictions. And that is, I think, a major challenge for the regulators. I think that they recognize it, but it's a very important point.
Well, the Fed also should have been overseeing, right? And the Fed didn't use its regulatory power or oversight.
Well, if you're talking about subprime, the first thing I would say is that the Fed was really among the first of the institutions to really sound the alarm in terms of saying very explicitly that there were problems in loan origination in various jurisdictions in the United States. And they have some powers in regulating loan origination, but I think given the fragmentation of regulation and the fact that a lot of this is really an element of consumer protection, which is often a state responsibility in the United States, they may have been reluctant to use what authority they had.
And are you talking Alan Greenspan's Fed or Bernanke?
Well, this is something that's been with us for at least since 2005, continuously.
Hi, my name is Mazen Darwaza. If this issue happened in regulated first-class, world-class institutions where you have the rule of law, where you have all the ratings, where you have all the agencies, how concerned should we be that this will not be a domino effect that will impact other financial institutions in the world? And this happened in the financial institutions of the world. So what's your vision about other financial institutions around the world? Is there going to be a domino effect?
Yes, Walter.
I think we see now, of course, the picture is emerging now, which institutions are involved, how much. This picture will become clearer probably in the course of this year. I do agree with Malcolm when he says the distribution model has actually probably prevented several accidents on the way over the past few years, because there was a much better diversified book of risks or credits in many institutions, and there were particularly less concentrations. So I'm actually more optimistic about that. Let me say one word about this disconnect. This disconnect between the source of the business and the ultimate holder of the security through various intermediate steps is of course working also against the quality of the investment in the case of restructuring of loans. Who is really interested now to go to the ultimate holder of such a mortgage and say, well, you know, how could we fix this somehow? A traditional savings institution who was doing mortgages, they would know the people which are in trouble. They would go to them and say, well, you know, we restructure it this way and that way. And so they would actually keep the book intact to a certain extent. There would be corrections here, corrections there, but basically the book would be relatively intact. Now, I wonder how this process is really evolving now in the United States, and who has an interest to fix it.
Middle of the room here.
Arturo Brennemore, Farmington Asset Management. I wanted to bring a slightly different point that has already been brought up, but in a different way. The problem is not so much the distribution method. After all, if the ultimate buyers had been widespread out small investors, we wouldn't think there was a crisis. We would think a bunch of people lost money, but there wouldn't be a crisis. The crisis occurred because the ultimate holders of the lowest credits were the financial institutions. And clearly some of them saw that there was a problem holding those credits, and some of them didn't. So I don't think we can go back to saying that the problem was with the system. The problem clearly was with those institutions who wanted to accept that kind of risk. Now the question is, if they didn't see it, can you expect a regulator to see it? And that is where the issue comes in. Are the people who are providing credit, the banks, are they going into too many other different businesses, or should they be regulated not in terms of what assets they can hold, but what businesses can they be in?
I think that with relation to this question, the problem was that many of the institutions that were in the distributing business, they got into the holding business, into the warehousing business, because it was a very good business to do these off-balance sheet operations, which in theory implied little risk and not very clear commitments, towards the the off-balance vehicles. And there was a lot of money to be made, and a lot of money was made in this business. That's why there was so much demand to this. Now, one of the issues was, of course, what is the relationship between the parent bank and the off-balance vehicle, and that is certainly a question for the regulation. In some countries, for example, in Spain, the Spanish banks did not get into this business because the Bank of Spain, when they were requests from some of the banks to go and put these SIV types vehicles, they said that's fine, but you have to put 8% capital on them. So again, this is a question of heterogeneous regulation across countries.
Middle of the room here.
Walter wants to say something.
Walter?
I just wanted to respectfully disagree with the gentleman before. Then when he said it would be if mom and pop would have bought these securities, we wouldn't know that there is a crisis. I think if that had happened, that these instruments would have been held by the retail investor, we would have a huge political problem at hand, and it would be much severe discussion about fraud, about everything than we have it now. I think it was actually a very good situation that professional investors were holding the bag at the end, and not innocent retail investors. Just
Lázaro Campos from SWIFT. I would first praise Mr. McDaniel to come to this forum unguarded, unprotected. Thank you very much for being with us. I'd like to take the discussion a bit beyond the rating agencies and really to the core of what the solution may be. And I do realize that we may be 1/3 or halfway of the way to really understanding what the impact of the crisis is. But what is the answer? Is it increasing or modifying capital adequacy requirements, Basel III? Is it a different approach to rating agencies and what they're, because these instruments by inherently they're very complex and financial institutions clearly have failed to assess the risk? Or is it regulation, which I don't think I would volunteer would be the answer, but what is the answer? The areas in your view?
Well, obviously it's a good question. We're in the middle of this financial situation, and it's not so easy to judge exactly what the ultimate solution should be. And I think one must be careful jumping to conclusions, because actually I believe that on balance the innovation in the financial system over the past 15 years has been very, very positive for world growth, for living standards, and for financial stability generally. So we don't want to jump to conclusions here. That said, there are a number of lines which clearly are coming through here. One is that there must be, as I mentioned at the beginning, there has to be more clarity and more systematic revelation of the financial condition of the big firms that are central to the financial system. Secondly, there has to be an improvement in risk management. And that will be particularly true, I think, in the area of liquidity risk management. In the area of supervision, I think the part of the challenge here has actually been that as the regulation of the regulated banking institutions has improved and become more refined and more risk sensitive, it's inadvertently created a pretty large incentive to engage in regulatory arbitrage. The old saying of, look, there's a great asset, I can't hold it because I'll have a capital charge, so I'll sell it to you, you hold it, and we'll make some deal about what happens if you don't have enough liquidity to keep it on your books. So I think that the regulation needs to be more consistent in such a way that the same risk gets treated the same way no matter what kind of institution is holding it. These are very general principles, I know, but I think that what will have to be found is the practical modalities for achieving those general objectives.
Okay. Just make one small addition. From the perspective of structured products themselves, I think the most important thing that we would hope to see going forward is that the information about the assets, the performance of the assets, their profiles initially and their performance on an ongoing basis is available to the institutional investor community as a whole, that it's not all being channeled through rating agencies. Certainly I want the institutional investor community to use our ratings, but if they don't even have the choice of making an independent, reasoned investment decision, if the only choice is to look to the rating agencies, it makes us both more necessary and less effective. And the reason it makes us less effective is because the buy side is not in a position to agree or disagree with any calls against the consensus that a rating agency might make. It doesn't have the information to do so. And so the rating agencies, as agents of the buy side, really can't demand support for the analysis or change in assumptions that they might see, because the investor community doesn't have the tools with which to agree or disagree with those perspectives.
That's a good point. All the way in the back.
I'm Raymond from Germany. I'm a shareholder in financial institutions. And I got the right punishment because there have been mistakes being made by the managers who I have employed as a shareholder. And they have obviously gone some wrong ways. That will happen in any kind of a system. And in this case, some of you may remember that the loans that have been subscribed to were called Ninja. No income, no job, no assets. And still they were written. And the financial institutions behind them, you know, did something with it like you harvest some sour grape wine and you mix it with something else and then put it into bottles and put a label on and then get a price for it. That has happened. Now, it is punishment. These people, these managers, have lost their jobs because they didn't act the right way. And we, the shareholders, got punished as well. My question onto this is, are we not hearing right now that there are some more risks in the world? What about the real non-recoverable loans out of credit cards? There are estimates 100 billion. What about the non-recoverable leasing loans in the car market in the United States, and not only in the United States? Estimates again in the hundreds of billions. Are we heading for more problem in risk assessment?
It's a good question. Should we be trying to avert a problem by looking for other holes, other risks out there? Walter?
No, I think first of all, there is in bank balance sheets are about risk, because basically there are always risks. And of course, we have now a very benign phase behind us until about the beginning of last year, when in the credit classes you mentioned, particularly the consumer loans, there was an extraordinary low default ratio, an extraordinary low problematic. And there is always regression to the mean. And I think what we see now is just a slowdown in the economy, which will the consumer loan will be hit by these kind of things. That is something which is really no surprise. Now the question is, are they properly priced? Can the business system actually absorb these losses, which in a cyclical business like consumer loan business is actually coming? But I say that since a couple of years, and it has never taken place. So now we see the first real signs in the economy.
Do you want to add to that?
Well, I guess I would just add, you know, if we're in a situation of deleveraging and asset price deflation, as I think we are, it's not very easy to judge where the next shoe is going to drop. The institutions that are prescient in that regard or lucky will be able to make profits from that. Those that are not will have problems. But I think with a lot of these other instruments, first of all, there is a lot longer history of their default rates. They may well be different this time, but they may be different in ways that some portfolio holders will be able to predict. And they're not packaged as much into SIVs and other vehicles as is the case with some of these more exotic CDOs. So if institutions lose money in these areas, they'll lose it more in the old-fashioned way, and that will be a little bit easier to recognize.
There is perhaps one point that could be added. You know, I think I'm much more worrying that contagion to consumer loans and auto loans and all that is the market for credit protection. You know, the insurance companies and the so-called monoline insurance, you know, that offer credit protection, which is bought mostly by banks and other institutions to hedge some long positions in risk. And there has been some concerns about, you know, counterparty risk in the sellers of protection. That's, I mean, as you know very well, the credit default swaps the spreads have widened sharply, even for sovereign emerging markets, which was not the case until relatively recently. So there may be a source of systemic risk far more important than the contagion to the types of loans that you were mentioning, like automobiles, credit cards, and so on and so forth. So this is, I think, one area where we have to be very vigilant.
Yes, please.
Other element of this, which I think is really, really important. We've said that we don't know how long this process is going to go on, and the longer it goes on, the more likely it is to leak into and undermine the real economy. And it's obviously when households are put under stress that they have payment problems. So in the case of car loans and credit card loans and general consumer loans, they're going to be put under a lot. Obviously, this group is a lot more indebted than it was 5 or 10 years ago. But that means that if this goes on long enough and feeds into the real economy, it can put a lot of pressure on consumers, and then I think that is going to create an even stronger negative feedback effect. And that's why I think more disclosure and more clarity would help, because it can get us to the right asset prices quicker.
Well, we've seen it feed into the U.S. economy. Have you seen it feed into the global economy yet?
Well, I think, obviously the action that the Fed took earlier in the week suggests that the Fed's very concerned about the macroeconomic consequences of what's going on. At this point, in terms of the numbers that we're seeing outside the United States, there are some signs of weakness here and there, but broadly, the indications still are relatively strong. Now, those numbers, though, are always a little bit looking in the rearview mirror. And I think what happens in the financial markets is going to be very important to how those numbers evolve outside the United States as well as inside over the next 3 to 6 months.
It's an important area to watch right there. Yes, sir.
Yes, my name's Larry Klain. I'm with currently Capital One, a major U.S. Issuer of credit cards and auto loans. And I'm pleased not to be on the panel, given the question. We did have our fourth quarter earnings call on Wednesday night, and I would direct you toward our loan loss reserves to get some insight into, just one issuer's perspectives on future losses. But my question has to do with incentives and business models for the rating agencies. You used the phrase in some of your last comments about an agent for the buyers. Obviously, you're compensated by the issuers, and that's been somewhat discussed as a potential conflict. And I'm wondering how you're contemplating that kind of core business model issue as you move forward.
Sure. I'll start by saying that I think it would be naive for anyone in the ratings agency business to say that there are not potential conflicts of interest in this business. I would amplify that by saying that the potential conflicts of interest exist regardless of who we get paid by. If we're paid by issuers, if we're paid by investors, if we're paid by governmental institutions, as long as we are paid by any entities which have either a public policy or a financial stake in the work we produce, we are going to be subject to pressures and efforts at persuasion. It simply is a fact of life. The question, as a result, I think really is, are we properly managing those potential conflicts, and how can we demonstrate whether or not we are properly managing the conflicts? The SEC has inspection authority over us. We have a code of conduct to which we are required to adhere. We have record-keeping requirements that show the trail of analysis for all of the securities that we rate, and those are subject to review and inspection. And this is actually where I think there is a value to regulatory oversight. And I realize that hearing a private sector players say there is a value to regulatory oversight may seem counterintuitive. But it's one thing for me as a CEO to stand up and say, Moody's does everything properly, prudently, and professionally. It's another thing to have periodic inspections as to whether we comply with our code, whether we comply with our record-keeping requirements, whether the processes have been adhered to, and having a third-party oversight body review that and either confirm or ask for fixes in those processes, I think is a value to the confidence in the market. And right now, confidence is a very rich currency.
Well, can I be a little bit provocative here? I fully agree with the gentleman back there. Apparently, the investor values the service of the rating agency absolutely minimal, because otherwise he will be prepared to pay. And in a way, a rating agency process is, in a way, something where a group of investors gets together, employs somebody who looks for them into the quality of assets they want to invest in. That's the classical organization such a thing to take. But apparently nobody is prepared to pay anything for the service. Now, is this an indication how they value it? Or is this just an indication that they think, well, somebody else is probably paying for it? That's the issue. But that's for me a very deep conflict of interest between and I have seen that. I have seen how eager rating agencies have actually been over the last several years in actually rating more and more and more of this stuff, because every time it was a couple of $100,000.
Well, I have to make
Could I add something to Walter? I mean, I think you're right that there's always the possibility of conflicts of interest. But I think that it would be stretching the imagination to claim that the conflict of interest that you have advising the issuers, rating the issuers, and getting paid by the issuers would be anything comparable to being paid by the buyers. That's one point. It's like if you are selling a house and you have an appraisal made, and that is the only thing, that determines the value of the house. I mean, in theory, the buyer should also have a stake on the valuation.
Well, as I said, I think there are pressures and potential conflicts from all quarters. And frankly, I think that a major institutional investor, especially one with a concentrated fixed income position, to think that institution, if it is paying large sums of money to rating agencies, is not going to be motivated to try and see that its portfolio is looked at in appropriate ways by rating agencies is somewhat naive. We have got to manage against those conflicts no matter who pays us. I would also point out in response to Walter's comment that there is a very substantial public good that comes from the current business model. First of all, the institutional investor community has a strong interest in ratings, but in a generalized way. They are interested that the market generally carry ratings. If there is an individual bond or security that is not rated, the institutional investor is not overly concerned with that. They are interested in the general existence of ratings. An issuer has a very different motivation. If it is issuing its bond, it wants its bond rated, and it is willing to pay to have that bond rated. That is not the same condition for the investor. And so there are different incentives in terms of a willingness to pay and a willingness to fund the rating agency business model. So given that there are conflicts of interest in different models, what's the good of this model? The good is that it allows us to publish our ratings to the general public for free simultaneously. The small investor has the same opportunity at the same point in time to see what we produce as the large investor. It's not a subscription-based model. There is no preferred access to the payer of our service to receive the output of our service. That is a value to the marketplace generally, and I think is an important offset when one is considering the different potential conflicts of interest and how to manage those.
Yes, sir.
Mr. Knight, you raised a very serious and very complex question a few minutes ago, which is the liquidity risk management, which was absolutely crucial which is absolutely crucial actually during the crisis. In what way could we improve the management of liquidity risk, which is a question not only for supervisors but also for banks?
I don't think there's, to my mind, there's not a general model of liquidity risk management. The way liquidity risk has to be managed depends on the individual portfolio of each institution. I think that probably the best example of this over the past year was Northern Rock. But we also saw in the period from last August that the liquidity risk management of the largest financial institutions was weaker than had been expected, and it's resulted in a dysfunctioning of the interbank market, which has been quite marked and quite disruptive. My belief is that the only vehicle really for improving liquidity risk management is stress testing. You have to make pessimistic assumptions about the likelihood that you're going to suffer a withdrawal of liabilities and determine in bad cases how you would maintain the liquidity to prevent that. So this is, I think, one of several areas where VAR analysis and so forth is really not much use to you. What you have to do is stress testing, and very rigorous stress testing. But I don't know, Walter, you might have a view on that.
Yeah, certainly, that was one frightening element, and has also changed, of course, the view how this interbank lending market has, in a way, come to a halt. I have never seen it before in this respect. Usually, if you come if you look at the interbank market and there is one institution in difficulties, the market as such is functioning. And this was sort of everywhere at the same time, and then this was titled mistrust among financial institutions. It was not so much the mistrust that the other institution would go bankrupt in the next 2 months. It was the mistrust that if I lend now, I'm not so sure they lend me, and therefore I keep my money for myself, and everybody was pushing an avalanche of cash in front of himself just for the moment that nobody would lend them anything when they needed it. And that was something which I, in my career, have never seen before. That's new. And that under this aspect, I think liquidity planning, liquidity stress testing, underlying assumptions will have to change, and everybody will have to have a close look how to deal with that.
Questions? Yes, sir. Right there. All the way to the end. All the way in the end. Right there.
I'm not sure whether I'm the only one who's struck, and that's right, Peter Gumbel from Fortune magazine, the only one who's struck by the sort of the mealy-mouthed nature of the self-criticism. I mean, there is some self-criticism on behalf of Moody's, which is very interesting. But Mr. Kielholz has said that for 5 years we knew about, over-exaggerated risk awareness, but we followed the lemmings. The BIS, when I looked at the annual report, there is on page 97 a small chart about CDO explosion and a few lines about the unknowns there. I'm just wondering, if you want to restore confidence, wouldn't it be good and constructive to say, sorry, we messed up?
Well, I don't. I wouldn't take pride in having been right, but you'd find our discussion of the dynamics of how financial balances build up even in stable macroeconomic conditions in all of our work, and not just on page 97 and not just last year. This is an issue that we got a lot of criticism on for a long time. But that said, like Walter, I mean, I have to admit very clearly that I was totally surprised by the impact that the withdrawal of risk had at the core of the financial system. That we didn't expect, and part of that came from the fact that the instruments that banks had built were, and I think to some degree, an element of regulatory arbitrage. There was a lack of transparency there, and so the linkages between the CIS and the ABC conduits on the one hand, and the bank's own needs for liquidity on the other were less clear than they should have been. So that's an area where I would certainly take responsibility for not seeing what was coming. But on the other part of it, no, I don't agree with you. I think I'd ask you to read our reports again.
We have time for one more question.
Sure. I guess I appreciate the comment that was made by Fortune. But clearly, in terms of, are there things that Moody's needs to change? Are there lessons learned? Did we identify shortcomings? The answer to all of that is yes. It would be, I think, completely disingenuous for me to sit up here and try to tell any of you that everything we did worked just perfectly and it was the world around us that failed. In terms of some of the more technical or mechanical components, I would point to shortcomings of correlation assumptions under stress. They did not perform well enough. Our assumption that the veracity and completeness of information we were receiving was higher than it was a shortcoming, and in hindsight, I think there are things we could have looked to question whether that information was as complete and truthful as it should have been. There are changes to our methodologies that need to occur, changes to our models that need to occur. We need to raise market awareness about what it is we do and don't do, so at least the criticisms are aimed at the correct attributes of the rating system, because the criticisms right now are quite diffuse, some of them valid, some of them not very valid. And I think we have to, again, through the regulatory inspection and oversight process, have a communication channel back out to the market that our work is proper and independent and is not in some way corrupted by the business model that we have. And finally, I think that we have got to have an acknowledgement that our role as a pure information intermediary in an originate to distribute world is probably not sufficient. And either we or others who would communicate information to us have got to retool processes to accommodate the consequences of an originate to distribute versus an originate to hold asset creation model.
So really it's transparency, not only transparency of the assets that we're talking about, but transparency of the role that the agencies play, and that means what it can and what it can't do, what they can and what they can't do. Gentlemen, thank you very much. Very informative session. We appreciate it. Thank you, everybody.